Good morning, guys, and welcome to today's edition of the London Session Open. It's 9:34 a.m. in London when I'm recording this market update, and we're gonna see what's going on in the markets. Before we start, though, as always, I need to stress that trading financial markets, unfortunately, is high risk, and we may lose all of our invested money. As well, this webinar is brought to you by ATFX, which is actually one of the larger brokers in China, and they're setting up shop, or they have set up shop here in London, and I'm doing this presentation from their offices. If you are interested in very competitive spreads, and I'm talking of very low spreads, not only on the majors but the minors, then do check out their website. As well, if you like this presentation, we are offering free coaching, and we have also a premium course coming up for people that open up accounts with ATFX. For more on this, just visit atfx.com/UK, and under trading, you can click on Retail Edge account to learn more about those competitive spreads that I just mentioned. Okay, let's begin. And this is the euro versus the USD, and the market is trading close to a low. Over the last few days, we have seen gold trade much lower. We've seen GBPUSD as well trading lower. New Zealand dollar is definitely been trading lower, and you have as well the Australian dollar, which is down quite a bit in the last few hours on the back of slow inflation figures in Australia. So the dollar is making good progress across many different currency pairs and markets, and it's an indication really that we might see further dollar strength going forward. It's actually one of the main ideas I've been sharing. I've been sharing with you guys, and as well also something I have written in the Q2 report for ATFX. Because you see, it's all about relative strength when it comes down to economies and macro fundamentals. In the case of the US, they just stopped raising interest rates, right? And on following that strong decline we saw in stock markets, the markets are right now sort of wondering if we're going to have, or at one point they were wondering if we're going to have some sort of a recession. That might still happen. But what's interesting here is that the U.S. economy, on like the ADP employment indicator, initial jobless claims, we never had a weakness in those sectors, and inflation remains relatively strong. Whereas in other countries, like for example Australia, you have inflation dropping quite fast, and then you have GDP that drop quite fast as well because of trade wars, and you also have their housing prices, which are down with about, I think, 12% or so in Sydney since their highs, and they're projected to decline with maybe another sort of 10% until 2020. So that's a big, strong decline, 20% from the highs in housing prices. So from that perspective, the US is doing quite good. And Europe here, you might remember we're talking about Germany and things not working out too good there. And the market here sort of has not priced that in. So the euro dollar has just been trading sideways for a long time. But now again, the dollar is making good progress against many different pairs. And we might have a break to the low here. And if we do have a break to the 2019 low at 111.75, then I do think we could potentially see further lower prices. This is not a pure rectangle pattern, but you have a triple bottom and then you have that high. So we have this sort of decline. If that repeats itself on a break to 111.75, then we could decline with about 267 points, and that would take out this low. Now we need to be a bit careful, but things are a bit different here. Be careful in a way that I remember very well this break here in August 2018, because I traded myself, and we're up for a few days, and then the market sort of moved back all the way back into the breakout point. And then here as well, we had a false break to the downside, and here as well, we had a false move. But maybe now again, it could be a bit different because the situation across many different currency pairs is now bearish. It's not sideways as it was before. So keep an eye on 11.75. Will break below that level, I suspect traders might look to short sell. Simple strategy that I like is that we move away from that range, and as long as trade below the high of the range, which happens to be right now today's high at 12.25, then that will be the stop loss for something like this. So then you're looking at a stop loss of about 53 pip, and the potential reward which obviously is not going to happen in 1 or 2 days, but maybe 2 3 weeks, it's a potential reward of 264 pips. So then your risk reward ratio is 4.92, and that's not a bad risk reward ratio. That's actually a good risk reward ratio. GBP versus the USD has already turned bearish, and as you know, it was bullish from this area, and we had that first bounce that worked out fine, and then we had another bounce which worked out okay, but then the third bounce we really never moved away from what I call the buy zone, and now the market traded to the downside. Now if you look at this from a 6-hour chart, which I also showed you yesterday, this is actually a descending triangle. You have 1, 2, 3, maybe 4 lows in the same area, and it's a horizontal level. I like to trade breaks of horizontal levels. I don't like to trade breaks of trend lines. And the difference between sort of this level and this level here is about 279 pip. This is something we can add here, so we get like this sort of target, which is just a 279 pip move. This is as well something we talked about yesterday. So if we would have shorted just below that level, then we would be in a bit of a profit right now. We would be in a profit of about 29 pip, 30 pip, and the stop loss would have been placed just above the high. So risking 64 pip to potentially make 277 pip, 271. That's a 4.23 times risk reward ratio. It might not work out, but it doesn't matter too much. What is interesting here is the fact that you have that good risk reward ratio. If we only stick to these sort of setups, this is a pattern that's been in place since 2 months or so, then that's really how you put the odds in your favor. And over the last few years, I made most of my money when I was trading the breakout out of these pairs. In 2014 I did really good, and also 2015. In 2016 I did not do too good because I started to meddle with short-term charts. And then in 2017 I had a good year again. In 2018 as well I had another good year, up with about 39% last year. In 2017 127%. So I was looked back sort of to what I've been doing since 2014, and as well just looking back because I actually started trading in 2006. So what actually helped me was waiting for these massive breakouts, major setups like this one. Here's the dollar versus the Japanese yen, and this is, it's a head and shoulders pattern, but there's not a lot of activity here. Fortunately, when the markets are the way they are, we can't do too much about that. But the trend is bullish, so I want to maintain a bullish bias. I think people will either buy a dip here because the trend is bullish. Independently, if this is a head and shoulders now, the trend is bullish above 110.81, and then alternatively take out the high. Now it's a little bit quieter here, and it could be because they have the Golden Week, which in Japan, which is a holiday, and I think that's supposed to start later this week. And what they do in Japan is that they literally take a week off, and it's like a big public holiday, so there's not a lot of traders and people taking on risks, and that could maybe explain why the market is already quiet, and it can easily explain why it can continue to be quiet. And you just need to be careful. I don't think we're gonna have a flash crash like this one here, which we had in January, but the likelihood of that happening has increased. Actually, on the top of my Twitter at AlexFX, I talk about that. If you haven't seen that video, check it out. I need to log in, but on the very top of my here, how to minimize the damage of a forex flash crash. This is a video I recorded, and in this one here, I talk about how I actually made some money on the crash in dollar yen, Aussie dollar yen, and also I think it was Aussie dollar CAD. I think it was. My memories, it's like a goldfish. Key point here though, the reason why I think I made money on that and I didn't get hurt is because I don't go about and buy things that are declining. This was already in a downtrend, so I think someone just got panic here and sold a lot of bought a lot of yens and sold dollars, and I think it was also Aussie dollars they sold, and it would be the same thing here. So it doesn't always have to be that it's just on the move to the downside. It could easily be we could have a flash crash, not a flash crash, but a very rapid move to the upside. So you need to be attentive to that. And as I explained in this video, if you haven't still seen it, it tends to be when you're with the trend, most of the news tend to go in your favor. And flash crashes as well tends to go in your favor. The only thing that doesn't, where this does not apply, is stock markets. They're very difficult to hedge against stock market flash crashes, because stock markets in general just move upwards and upwards and then they decline. They say the market takes the staircase to the upside, so takes small steps to the upside and then takes the lift to the downside. Okay, let's move along here. And these are gold prices, and gold prices are bearish as well, and they're bearish below 1290, I would say 1281, sorry. So a few days ago I turned bearish here, and I actually shorted myself on my own personal account here, and the stop loss on that position is now a break even. I have shorted a bit more. My initial risk was 1.5%, but the stop loss was on this one, on the first position was here. I pulled that here now, so I'm actually break even on that one, and then I shorted a bit more, so my total risk right now is 1%. And at moments here I've been up with almost 4%, and if the market declines here, the risk reward ratio is very, very good. The initial risk reward ratio was 5.4, and even if we don't even go all the way down to target, if we just go to maybe 1250, 1240, and I can reduce my stop loss on the way, and then I get stopped out one day when the market just decides to go upwards, then I will still have a good profit. Now, if we ignore the fact that I shorted again here and just look at the big first position here, well, that first position is a break even. So if that was the only position I'm holding, and I'm not acting any differently, but I would just put the stop loss at that break even level, and then you see how far this goes. And in the worst case, you know, we get out of break even, and the best of wills, we get out with a nice risk reward ratio of 5.4. And the reason for being bearish here is that head and shoulders. And as you know, I talked about it for quite some time. On the way up here, we talked about it already here. And I waited. I mean, it was evident that this, obvious that this was a head and shoulders already in March 25th, but it was literally almost a month later on April 16th, which I actually acted on it. And here, nothing has really changed. Now, these are crude oil prices. And crude oil prices, I did an update that on Twitter. I replied to some people yesterday. So you can see this is I can't do it because I'm actually logged in here. I'm not logged in here, but crude oil prices are about to reach a head and shoulders target. When we did this analysis here, there was few people that believed in this, and these big patterns on head and shoulders, they're actually really good. They're not always going to be right, but the key point is this: when you write big, like this, a 21% move. And I'm not going to say it was easy. I got stopped out, I think 2 times here. I gave up on this one, and I traded something different, something called gas oil, and I made money on those time on that move, on that market 2 times. Despite, you know, being stopped out by Donald Trump once. I think it was here somewhere in March, when he sort of sent a tweet out to OPEC that they should lower prices. And the reason for telling you this is how these big moves, these are the big moves that a lot of people just dream about to trade, especially if they can trade that in combination with a short-term position. So imagine you have a short-term position with a tight stop loss, and then you happen to get that move. That's really when you just grab a few of these a year, maybe 2, 3, and then literally you be really good, even if you have a low risk. Now, for this market right now, the reason as well talking about the head and shoulders is that I think a lot of people are getting excited and like, oh, it's time to buy, it's time to get involved. However, it's not that time. It's the time to actually look to scale out, even though the current situation and the macroeconomic news that caused this price to move to the upside. Now, if you still want to play the long side, I don't mind that. In the case of crude oil prices, they're famous to go way up too fast and way down too much, right? They sort of is the way this market works. But we need to be very wary about the entry point, and the entry point is down here at that breakout point. This gapped, with my broker at least, it gapped. Here it doesn't show like it did gap, but with my broker it gapped. It was trading here on Friday, then the market was trading up here. So we will, I'm not saying we will have to close that gap, but it will be fully normal if we try to go down and at least try to touch the highs here from April 9th. Now here's the S&P 500, and it's looking really, really good as well. We talked about buying here, as you might remember, and we are now at pretty much at target and at those highs. It's been bullish for quite some time, and yesterday I was looking on Twitter. I follow a few friends and obviously a bunch of other people, and I think it's very useful to get the mood of the market. And I have a friend of mine. He's been bearish for as long as I remember. He's one of those people that are usually just bearish. And yesterday he put a pattern in the Dow Jones showing that it's a broadening top. Again, that's sort of typical bear interpretation where you were wrong on your first analysis and then you sort of try to angle it and like, oh, maybe it wasn't a double top, triple top, whatever you want to call it. Now it's a broadening top. And that's actually really good because the perma bears are not really, they don't understand what was happening up here. As well, if you go on Bloomberg, it's not that it says in big, oh, new all-time high. But yes, we are at a new all-time high. I think everybody, buy and hold investors, but also short-term traders, they don't understand what we're up here. And full disclosure, I was bearish heading into last year's decline. And then I turned bullish on the basis of the charts. But I had no idea that the economic situation would change the way it did, and suddenly everything else looks okay again, and we might even have a deal between US and China. But the charts were there, and the charts were telling us to be bullish, and that's where we are right now. Now, again, sort of the way people have reacted to this current rise in price, it feels that they're not on board, and then they just try to sort of, oh, look, broadening top, instead of just admitting defeat. So that's good, because that means that that trend here we're working with could potentially continue to advance. So this is looking good. And again, we don't want to be buying up here. At least that's not what I would have done. I would be buying down here, as I suggested last week. And up here is time to book profits. Now I think we can reduce the trend defining level to this level down here, so just below the low, and that would suggest that, so that would show that you pretty much break even. And I think this could probably go up a bit. The market loves to mess with bearish people and bullish people sometimes as well, but in particular the bears. So the bears probably have their stop loss orders just above here. So that's what's probably going to happen. It's going to go up there. Those guys are going to get really, really nervous, and they're going to say, oh, let's close down the positions. So they close down the positions. Now, if you're short and you're going to get out of a short position, you need to buy back, right? So when you buy back and they buy back up, they lift price to the upside. So you probably have that little push, and then we'll see what happens, but probably a little bit of a pullback. And if we do pull back, we're going to go down probably to 29.10. And as long as you trade above 28.86.6, I'm going to be bullish, and I think people are going to be buying here. Now, it seems to be very, very easy to trade these markets. And for now, it is. Eventually, though, I think what's going to happen is that we're going to have a steeper decline like that. And that's going to come a bit of a shock. It's like a cleansing of the system, like a 3.4% decline, maybe 5% decline, maybe even. I think we could technically go all the way down to something like 27.85 without really changing things. So yeah, 4.5% decline, and then I suspect they will try to stabilize, and that's going to happen at one point. What you need to do, though, or the way I would do it, is that this is the buy zone. You want to do similar buy zones in the other markets and see, like our 2 out of 3 markets in the buy zone. Then that's a good indication that it's probably time to buy. Now let's move along here, and let's take a look at the German DAX. So this is the German DAX, and the German DAX is very stubborn. I'm sure people that bought down here on the Head and Shoulders indicated in the beginning of April are very happy. And it might go to that target. Now that target is probably a good time to book profits. The alternative is we move to the downside and then we go upwards. Now let's see if you guys have any questions. I'm gonna load it here on my mobile. Unfortunately, there is it's always when you're dealing with IT that are not present. It just takes longer time. This is the way the world works now. So is IT here is not based in London, so I need to sign in here via my mobile. And yes, it looks like we have no questions. So we're gonna finish up. We have Anas Dora says, thanks for the analysis, very insightful. Thanks so much, Anas. Thanks so much for joining in the chat. So we got a question on the Dow Jones. Sure, let's take a look at the Dow Jones. This is the Dow. I haven't done some analysis on this one for quite some time. So this is the daily chart. I do like the daily chart. So this was a triangle. This is a triangle that had price stuck here, and then the difference between, so the base here was 3 sorry, I'm still struggling a bit with a cold. So the difference here was about 879 points. So this was the breakout point here, okay? And the target for this pattern is up here. And I think still we can trade that to those levels. If you look at this level down here now, that's the trend defining level, which is 26,048. Here, let's just stick to the daily today. If we have a decline, maybe we slide below the first 2 days of the week, those levels. I think that could potentially be interesting to get involved, to try to target that high, and then we could potentially go upwards. So that is what I would look at. As for the broadening top that I mentioned, that my former colleague was posting, he did it like this. And this is a broadening top. It's still some sort of a top. The idea is, some people call it the megaphone pattern. It's a very difficult pattern to trade, but the general idea is that we go up to the high and then reject it from the high and we go lower. That's the general idea. But as you can see, it's a very difficult pattern to trade. Usually the markets don't develop into these sort of patterns, and the reason for that is that volatility doesn't tend to be like this. It doesn't tend to be an extreme overreaction to the downside and an extreme overreaction to the upside. What happens when something like this is that the market sort of starts to trade sideways, but you can definitely see this pattern sometimes developing. So yeah, so I will remain bullish above 26,048, and much like the other markets, I think you need a bit of a pullback if one would like to get involved. This is the resistance level at 26,959, and we need to take that out. Sorry, that will be the target, these two levels, and I suspect we're gonna take those out. Okay, I think we're gonna wrap things up because we have more questions. Oh, we got a question from Ronnie. Can we take a look at the Euro Aussie? Sure, let's take a look at the Euro Aussie. And okay, so this is the Euro Aussie, and this is a bit of a difficult one, Ronnie. It's because it's trading sideways for such a long time. And the problem here is that you're pitting one currency, which is the Australian dollar, which is weak because of those inflation figures, against the euro area, the euro, which is a pair where we know that Germany is not doing too good. Now, I didn't have time to check out the IFO indicator this morning, but in general, things are not looking too good in Germany. And because of that, you're dealing with two currencies that are both weak. because of their own sort of circumstances. So that tells me that we could continue to trade sideways for longer. So right now, obviously spiking upwards, maybe we'll spike to 160, but I don't really think we're gonna break out of this range anytime soon. And every time it starts to get into a sideways range like that, I suggest to stay away unless you have a good strategy for this sort of market. And I don't. I tried to develop for a few years, not for a few years, but I spent a few months, and so to try to figure out how to deal with these sort of situations. But what I do is just I ignore markets that look like this, and rather look for either a bullish breakout or a bearish decline. Okay, we're gonna wrap things up. Guys, don't forget to hit the like button on this video. And if you're not already subscribing, don't forget to subscribe. Let's get this show trending. That would be amazing. So all of you guys that watch these videos, I think it's about 40 to 50 of you guys every day, click on that like button. And if you're not already subscribed, make sure you subscribe as well. Don't forget to support on Twitter. Sharing is to caring. Why? Because it's very straightforward. You know I love trends, right? And I love momentum. And I want to build this into a nice show, a nice update every day with a lot of people coming, and it's very straightforward. We try to go with the momentum, we try to go with the trend. So if you like it and share it. If you don't like it, it's fine, and I'll get indications that people are not that interested, and if they're not interested, I won't do it. Okay, have a good day, guys, and I'll see you guys tomorrow same time. Thank you.